Whenever you're looking at a investment opportunity, and these are all standard terms, I'm sure you've heard, many of you have heard these terms before, but I want to put some definition behind them and explain what they are and how they're used to calculate the value of in your underwriting of your investment opportunity. The first one is called the cap rate, and sometimes it's referred to as the capitalization rate, but many of us say we use the short version and just call it the cap rate. And the capitalization rate is the ratio of the net operating income to the sales price. So remember, income minus expenses gives us our net operating income. So you take the net operating income, divide it by the purchase price, and what this does, this capitalization rate shows you how quickly the property pays for itself. So if you're offering at a certain price, and you take the NOI and divide it into there, if it comes to a 10, it's going to take you 10 years to pay for that property. So the capitalization rate is basically the amount of years it's going to take for the property pays for itself. Again, NOI divided by the purchase price gives you your capitalization rate. On the cash-on-cash return, it is the ratio of the remaining cash after debt service to the invested capital. So we have, going back, we have income minus expenses is our NOI, and then we have to pay our mortgage, don't we? We have to pay the debt. We have to pay the debt service to the lenders. So whatever cash is left, you divide that by the amount of money that was invested to get your cash return. So if you invested or your investors put up $1 million to buy your apartment, and after you paid your bills and you paid the debt service, you had $100,000 that you made that year. 100,000 divided by the million gives you a 10% cash-on-cash return. And that's pretty good. That's not bad at all, particularly if you do this in the first year. It's really good. So you're looking for, again, the ratio between the debt service and after the debt service, the cash remaining, divided that by the purchase price. The next item, the third item, is the debt coverage ratio. Sometimes it's referred to as the DSCR, which is also known as the debt service coverage ratio. And what that does, it measures the relationship of the amount of cash available to service the debt payment, which is the net operating income to the required debt payment. So let me explain this. We have income minus expenses, and then we have our net operating income, our NOI. Now we have to make our payment. So what this is that is there enough money to make the debt payment? Can we pay the mortgage this month? And how much money do we have beyond the debt payment? If our debt payment is for our mortgage is $10,000 and we've got $12,000 remaining to pay that $10,000, then our ratio would be 1.20. It would be 1.20. So we would have 20% more cash in order to be able to pay that debt service. So the ratio would be 1.20. In most loans today, when you're buying an investment, the lender's looking for a 1.25 or a 1.30 in some cases. So you want to make sure the lender, in order for them to lend, is going to make sure that you have plenty of money to pay them. The bank wants to make sure that they get paid, and throughout your investment within your loan documents from the bank, the lender's going to have a stipulation there, they call it a covenant, and you're going to have to be able to maintain a certain debt service coverage ratio minimum every year, and your investment gets evaluated by the lender every year to make sure that that debt ratio is being maintained and the loan is not in any kind of jeopardy. So it's a really important number that we look at. It's important to you, it's important to the lender, and it shows you that, you're making a profit. You're making money because you have you're not at a break even. In the years past, before that helped create that real estate bubble, people were lending if the debt ratio was 1.0, which means was break even. So if you had a bad year, you had more expenses, then your income was less than your ability to pay your loan, and people got in trouble. And they were, lenders were lending, as we know, it was a pretty crazy time. And so you could get a loan and have a debt ratio of break even, and sometimes below. They would be willing to risk, capital in order to make a loan. So, but not anymore. The rules have all changed. The whole market, the capital markets are different. They're trying to protect their capital, and of course you want to protect yours and your investors' capital by making sure that you have enough income and your purchase price is where it should be in order for you to make a profit and pay your debt. So the last item is the total return on investment. Now what this is it's another step beyond the cash return. So what it is, it's the total cash plus the equity. And this is the value that you built up over the life of the project, over the life of the investment. And it's divided by the cash invested in the deal. Then it's divided by the number of years in the investment to get what's called the annualized rate of return. So let me give you an example. So every year you're going to be paying X amount of dollars to your investors as a preferred rate of return, because you're going to be involved in a profitable investment. So every year, every quarter, you're going to be making cash payments, and that'll be your cash on cash return to the investor. So we've already figured that out. So at the end of the investment, say it's a 5-year hold, you bought the property for $5 million, but now it's worth $8 million. So that's a $3 million increase in value or increase in equity. So if you made $3 million and of additional money, and you paid your investors $1 million over the 5-year term, that would be a total of $4 million that went to your investors. And so if your investors put in $2 million, you pay your investors their $2 million back. Okay, you pay them the money that they put in the deal back, and then you take what's remaining and divide that by 5 years to get your total return on investment. The total return on investment is typically annualized. So whatever the total amount is minus what they put in, divided that by the number of years you held the property, gives you your total return on investment. So if you're going to have to work with the numbers a little bit, and you're going to have to run some of your own scenarios, and when you're talking about your deal and your cash, believe me, all of this is going to make a lot more sense to you. So what we're going to do now is that we're going to have a quiz, and as soon as we complete that quiz, then we're going to go and we're going to get into our lesson 6 and talk about property types. So good luck.